From 2010 to 2019, the inflation rate in the United States averaged 1.7%, below the 2% target rate of the Federal Reserve. But in June 2021, the annual inflation rate was 5.4%, the highest it had been in over 12 years. The chairman of the Federal Reserve, Jerome Powell, has said that this is temporary and reflects a shock going through the system associated with the reopening of the economy after COVID-19. Others are less sanguine and worry that this might be the start of a new inflationary period. But what caused this recent rise in inflation? What are the arguments between the transitory versus sustained inflation views? And how worried should we be? Inflation is the rate of increase of prices, and an increase in prices means that the same amount of money buys you fewer goods and services. For example, say that it currently takes $1 to buy a pound of bananas. If next year you need to spend $1.05, then your money has lost some of its purchasing power. If the price of a pound of bananas stays at $1.05 for one more year, then the price stays high, but there's no inflation, since it didn't rise any further. The key thing here is that inflation is the change in prices. Of course, we're not just concerned with the price of bananas, but on a wide range of goods and services. Bananas, but also cars, rents, medical services, and so on. Statistical agencies collect price data on a very large basket of goods and use it to construct a price index. In the US, the Bureau of Labor Statistics, the BLS, calculates and reports the inflation rate, analysing prices of a representative basket of goods for a typical consumer. The inflation rate you hear reported each month is the percentage change in this price index in a particular month as compared to its value a year previously. But is inflation a bad thing? Well, it's worse for some than for others. The people most adversely affected by inflation's erosion of purchasing power are those on fixed incomes, especially retirees, and those whose wages don't adjust to higher prices, like those paid the legal minimum wage. And these effects are especially strong when inflation is unexpected and people are surprised by the higher prices, so they didn't see an adjustment in their incomes. If someone signed a contract or negotiated wages when inflation is expected to stay low, they could lose a lot if inflation rises. And these aren't the only losers from inflation. Creditors who've lent money on fixed rates tend to suffer because they're repaid using dollars with less purchasing power. But on the other side, borrowers often do well if they've agreed to a fixed interest rate. Their incomes rise with inflation, but they're paying back their loans in cheaper dollars. More to the point, people just don't like inflation. This was especially apparent during the last period of high and rising inflation in the 1970s, when polls revealed that inflation was viewed as the biggest problem facing Americans. Inflation was only brought down in the early 1980s, when the chairman of the Federal Reserve, Paul Volcker, headed a move to dramatically raise interest rates. This led to a major recession with a huge increase in the unemployment rate, reaching 10.8% in November and December of 1982. Inflation continued to stay low during the period called the Great Moderation of the 1990s and early 2000s. In fact, inflation has been especially low since the onset of the Great Recession, even causing concerns at points that it was too low, below the target rate of 2%, as pointed out in Michael Klein's memo from 2017 and by Dan Sickle in 2019. The dramatic rise in inflation in the summer of 2021 hasn't reached the 7.5% average during the 1970s, but it is still well above the Fed's target. However, in an EconoFact podcast, Jay Shambaugh notes that the high rate of June 2021 partly reflects the fact that prices had gone down in the middle of the pandemic. So the comparison with June 2020 is actually with a time when prices were especially low. Jay suggests looking at inflation over a 2-year period. And when you do this, headline CPI is around 3%, with core at 2.8%. That's still above the Fed's target, but it's nowhere near as shocking as June 2021 reports make out. So we know how inflation is calculated and the problems posed by high inflation. But how does it actually get there? How does inflation rise? As Menzies Chin states in his EconoFact memo, inflation reflects three factors: demand, supply, and expectations. Demand and supply, of course, is the bread and butter of economics. Demand could be high because of a strong economy, so people have more to spend. Demand could also be high because of government support, like what we've seen during the pandemic. Plus, because people couldn't spend money on things while COVID was raging, as the pandemic eased and restrictions were lifted, the demand for things like restaurant services surged. If supply can't keep up with demand, prices rise. Supply may also be constrained by other factors. For example, auto production has been hampered by a computer chip shortage, and with people locked down in their households, there have been fewer defaulted cars to enter the used car market. In 2021, price changes in the auto sector may have actually caused 40 to 50% of the price increase in the core CPI. Supply can also be affected by factors that directly affect the cost of production. For example, the rise in the price of oil in the 1970s made production more expensive, and these costs were passed on to consumers. However, it's the third factor, expectations, that is absolutely key for ongoing inflation. When writing contracts for wages or pricing objects or rent, people, unions, and businesses take into account prospective inflation, and these expectations feed into the actual inflation rates. This is what makes inflation so hard to control, like in the 1970s. If inflation is expected and consistently factored into future plans, it's likely to keep on rising. In 2021, each of these factors raises concerns. As well as the pent-up demand for spending following COVID restrictions, several policies helped support demand. There's the Fed's commitment to keeping interest rates low, the $1.9 trillion American Rescue Plan, and the previous administration's $4 trillion stimulus. As for supply, the rising costs of inputs were clearly a factor during COVID, and bottlenecks may continue to pose supply chain issues that could drive up overall prices. But remember that inflation is the rise of prices. For these supply effects to have a persistent effect on inflation, these price increases would have to continue at the same rapid rates. And we see evidence of reversals in some supply constraints. Jay Shambaugh, in his EconoFact Chats podcast, points out that the demand for lumber increased as interest in home building and home improvements grew in 2020, but subsequently fell as supply rose to meet the higher demand. We don't readily observe the third factor, expectations, but we can draw some insights from surveys and financial market data. A survey of professional forecasters in May 2021 implied an expected inflation rate of 2.4% over the next year, whilst longer-term expectations have been relatively stable. As for financial markets, long bond rates are in the 1.2 to 1.4% range. And since lenders want to protect themselves from inflation risk, as we mentioned above, these low interest rates don't reflect towards fears of high inflation. The inflation spurt in 2021 is unusual, and we don't see many other examples like it. Chairman Jerome Powell's assertion that this is a temporary shock that will wane depends upon stabilisation of demand and supply. But experience with inflation tells us that if people expect ongoing high inflation, the cost of reducing it through a recession could be extremely high.